All right, let's unpack this. Today, we're doing a really critical deep dive. Our main focus is getting you, our listener, the loan officer, studying hard, equipped with the precise knowledge you need, and those crystal clear distinctions, all to help you absolutely ace that SAFE exam. We know you're aiming for that perfect score, 100 out of 100. And that's exactly what we're here to help you prepare for right now. We're going to stick really close to the source material, pulling out those key definitions, rules, facts, the stuff you have to know. Think of this as like your personalized study session. High yield, focused on making sure everything sticks, especially those tricky details examiners love.
Yeah, what's interesting here is that the SATE exam is not just about, getting the general idea. It really demands you master specific definitions, specific regulations, often word for word. So we're not just understanding concepts broadly, we're aiming to internalize them with pinpoint accuracy because honestly, that's what a perfect score takes. So our journey today, it's going to cover the ethical foundations, then dig into the different types of fraud. We'll break down the SAFE Act itself, all the details, and then lock down those essential federal laws and, general mortgage knowledge. Every piece is designed not just so you understand it, but so you can recall it perfectly on exam day.
Okay, so let's start right at the beginning. The foundation. The why behind all these rules. Ethics. These aren't just like random rules they came up with, they're principles, right? Built over time, specifically to protect consumers and make sure things are fair. Because, let's face it, mortgages can be complex, overwhelming sometimes. And understanding why the rules are there often makes the actual details easier to grasp, maybe even seem obvious sometimes.
Exactly. If you connect this to the bigger picture, a lot of these key laws, the ones you're studying right now, they came directly out of major market crises, the fallout. They were designed to fix serious ethical problems that became painfully clear, often at a huge cost. So knowing why they were created, their original intent, it really helps you understand their scope, which is vital for the exam. It helps you remember the reason for the rule, not just the rule itself. Take the Real Estate Settlement Procedures Act, RESPA. Its ethical goal is super clear, almost simple. It aims to curb the unethical practice of charging consumers unearned fees for settlement services. Now, for your exam, lock this in. The core concept, the thing they love to test, is unearned fees. RESPA is all about making sure people only pay for legitimate services actually performed, things that were earned. If a fee isn't earned, RESPA is probably involved somehow.
Okay, unearned fees for RESPA. Makes sense. Then there's TILA, the Truth in Lending Act. This one feels like it tackles a whole bunch of ethical issues at once, doesn't it? It seems much broader.
You're absolutely right. TILA's ethical goal is very broad. It covers a whole range of things that impact consumer trust. The official goal addresses a range of ethical issues, including deceptive advertising, predatory lending, deceptive appraisal practices, and originating loans without a good faith determination of the borrower's ability to repay. See how wide that is? It looks at how loans are marketed, stopping those bait and switch tactics. It covers how they're structured, guarding against unfair predatory terms. It even touches on appraisals, making sure they're objective, and, crucially, that whole ability to repay piece, making sure the borrower can actually afford the loan, responsible lending. For your exam, remember, TILA is broad, but really focus on deceptive advertising and that ability to repay requirement. Those pop up a lot.
Right, and tied closely to TILA, almost like a fetish-sized part of it, is HOPA, the Homeownership and Equity Protection Act. It sounds like it focuses on a very specific area within TILA.
That's exactly the kind of precision you need for a perfect score. HOPA is a component of TILA. HOPA specifically targets predatory lending by prohibiting a particular acts and practices associated with high-cost loans. So when you see questions about high-cost loans or predatory practices, think HOPA. But here's the really critical distinction, the one that trips people up. Remember, it's not standalone. It is part of TILA. That relationship, how it fits inside TILA, that's a common test point. They want to know you understand that structure.
Okay, shifting focus a bit. What about protecting private info, personal data? That's huge today, not just ethically, but legally, reputationally.
Oh, absolutely critical. That falls squarely under the Gramm-Leach-Bliley Act, or GLB. Its core ethical goal is to fulfill the ethical obligation to protect the privacy and confidentiality of consumers' personal information. So GLB equals privacy and confidentiality. That's your immediate connection. It's all about protecting sensitive data from when you get it to when you securely get rid of it. Not optional. It's mandated.
And finally, the bedrock of fairness. Preventing discrimination, ECOA, and the Fair Housing Act. These are the big ones, right?
Exactly. The Equal Credit Opportunity Act,
Yep.
ECOA, and the Fair Housing Act, Together, they prohibit the unethical and illegal practice of discriminating against applicants based on protected personal characteristics.
Yeah.
These are your absolute main anti-discrimination laws in lending. Everyone gets an equal shot. And memorizing the full list of protected classes we'll get into that soon, it's not just important, it's absolutely critical for that perfect score. Non-negotiable knowledge right there.
Okay, so from ethics, let's move to the opposite end. Mortgage fraud. Something that destroys trust. The FDI has a very specific definition, and you need to know it for the exam, right? They want you to get the gravity of it.
That's right. The definition is precise. Mortgage fraud is the intentional perversion of the truth for the purpose of inducing another person or other entity in reliance upon it to part with something of value or to surrender a legal right. End quote. Let's break that down. Every word counts. It's intentional, not a mistake. It's about twisting the truth, perversion of the truth.
Okay.
And it's always done to get something of value, usually money, or to make someone surrender a legal right. This definition sets up the two main types of fraud you absolutely have to distinguish between for the exam.
And these two types, they're really different in why people do them and the impact they have. That distinction is key for the test, I bet.
Absolutely critical. First, there's fraud for profit. People often call it industry insider fraud. This involves the conspiratorial involvement of unscrupulous individuals from all areas of the mortgage lending industry. Notice, conspiratorial involvement, it's usually not just one person. The motivation. Purely illicit financial gain. This type is devastating for the industry. It accounts for an estimated 80% of all reported fraud losses and is the primary focus of federal enforcement agencies. Think large-scale, organized crime defrauding lenders. Common methods include using inflated appraisals, falsified loan documents, and straw buyers. It's often complex, involving multiple people working together.
Can you give us a clear example, something that shows that conspiracy part?
Sure. Imagine a real estate investor runs a ring. He pays people to use their identities. Those are the straw buyers. Then he works with a broker who's in on it, maybe a former broker, to create fake job and income docs. And crucially, he gets appraisers involved to inflate property values. The goal: steal huge amounts of loan money from lenders who think it's all legitimate. You see how multiple insiders or people connected to the industry are involved, all trying to profit illegally by tricking the lender. This is the big problem, the systemic one. That 80% figure really shows its impact.
Okay, so that's the organized crime version, sophisticated, large scale. But the second type, fraud for housing, sounds really different, especially the borrower's intent.
Yes, and this is where you cannot get confused on the exam. Fraud for housing is defined as the use of false or inaccurate information by a borrower to secure a home loan that they genuinely intend to repay. See the difference in motivation. It's to purchase a home they would not otherwise qualify for. This is often just someone desperate to get into a home. The methods usually involve things like misrepresenting employment history, credit history, income, assets, or the intention to occupy the property. Maybe fudging income numbers a bit.
So the absolute key distinction for the exam, the thing they'll test you on, is that in fraud for housing, the borrower intends to repay even though they lied to get the loan.
You nailed it. That is the critical difference. Don't mix these up. Here's a common scenario. A first-time homebuyer, let's call him Jude, doesn't quite have the down payment. He gets a loan from the seller to cover it, which creates a second land. But then he tells his loan originator the money was an inheritance to hide that second loan. Jude clearly lied, misrepresented his funds. But his intent, to live there and pay the mortgage, that intent to repay is the bright line separating it from fraud for profit. The exam will definitely test this difference with scenarios.
So now that we get the ethics and the fraud types, how do these ethical ideas actually show up in your daily work? Let's look at RESPA first. How does its ethics translate into specific rules?
Right, this is where theory meets practice. RESPA's core purpose, remember, is to eliminate unearned fees and prevent harm to consumers from undisclosed relationships. This shows up directly in Section 8 prohibitions. For the exam, you need the exact wording. First, RESPA prohibits giving or accepting anything of value. Think money, discounts, tickets, favors, for the referral, a settlement service business. Any referral itself is not a compensable service. So no kickbacks just for sending someone to a title company or an appraiser. You can't get paid just for the referral itself. Second, it prohibits sharing or splitting fees for services that were not actually performed. If no work was done, you can't split the fee for it. These are the core anti-kickback rules.
Okay, no kickbacks, no splitting unearned fees. But what about legitimate affiliations? Like if a real estate company owns a mortgage company, how does RESPA handle that?
That's where affiliated business arrangements, or AFBAs, come in. This is a major test topic. because they can be legal or they can be illegal shams. To be compliant, an FBA must meet three specific conditions. Know these verbatim. 1. Disclosure. The relationship must be disclosed to the consumer in writing using the format required by Regulation X. The consumer has to know about the connection clearly up front. 2. No required use. The consumer cannot be required to use the affiliated provider with limited exceptions. This is huge. You can suggest, but you generally can't force them to use your affiliate. They need a real choice. 3. Limited benefit. The only benefit allowed is a return on ownership interest. Any profit must come from your ownership stake, not from individual referrals. No extra bonuses just for sending clients to your partner company.
Makes sense. So if any one of those three isn't met, it's potentially a sham arrangement. That sounds like a big violation.
Exactly. And the exam will test this. Here's an example of a sham. A home builder refers all buyers to one specific mortgage company. They get a cut of the loan proceeds for doing this. Now, they do tell the buyer they can choose another lender, technically checking box, #2, but they illegally failed to disclose their profitable financial relationship, the kickback, essentially. That violates condition #1, making it a sham to them. Even ticking one box isn't enough. You need all three. Always remember the three conditions for a compliant FBA. It's a very common test area.
Let's swing back to TILA, specifically about advertising ethics. Mortgage ads are everywhere. What rules stop them from being misleading about, arguably the biggest loan someone will ever get?
Right, TLA and Regulation Z establish strict rules to prevent deceptive advertising that could mislead consumers about the true cost and terms of a loan. For the exam, you need the specifics. These prohibited practices are prime examples. Misleading use of fixed. Using the word fixed for a variable rate product without conspicuous and equally prominent information about the variable rates. Can't hide that the rate changes. The warning has to be just as obvious as the word fixed. Misleading comparisons. Making statements like, save $300 a month, which imply a comparison to a consumer's current loan without providing required disclosures. Sounds great, but you need the full picture fees, total cost, terms. Misrepresentation of government endorsement. Using official logos or language that suggests a product is endorsed or sponsored by the government. Big no-no. Can't pretend Uncle Sam backs your specific loan product, and this one's specific and often tested. Misleading use of counselor. A for-profit lender or broker cannot refer to its employees as counselors in advertisements. Counselor implies unbiased advice, which a for-profit entity isn't providing. These examples perfectly show TILA's spirit. You need to know them.
Switching to privacy again. With all the sensitive data MLOs handle, how does the Gramm-Leach-Bliley Act, GLB, ensure it's handled ethically and securely? This feels critical for trust.
GLB is the guardian here. It mandates the protection of consumers' non-public personal information, NPI. It's a legal requirement. The core of this is the Safeguards Rule. It requires financial institutions to have a comprehensive written information security program. For your exam, you need to know the pieces of this program. It's detailed. First, you got to designate a qualified individual to oversee the program. Someone needs to be in charge. Second, conduct a risk assessment to identify internal and external threats. Know your weaknesses. Then, implement safeguards. You need to design and implement safeguards to control identified risks, including, and here are specifics, encryption of all customer information, essential for data security. Multi-factor authentication for accessing information systems, more than just a password. Secure disposal of customer information no later than 2 years after its last use. Can't just shred it casually. There's a timeline and process, and it doesn't start there. You have to regularly test and monitor the effectiveness of safeguards, including annual penetration testing. Try to break your own system to find flaws. You also need to provide security awareness training for all personnel. People are often the weak link. And oversee third-party service providers. You're responsible for who you share data with. Plus, establish a written incident response plan. Know what to do when a breach happens. And finally, provide a report to the board of directors at least annually. Top-level accountability. That's a lot, I know. Focus on the types of safeguards, the testing, and the reporting. Those are key areas for the test.
Now, let's talk about fundamental fairness preventing discrimination. Absolutely core to lending. Equal access for everyone.
Couldn't agree more. This is the Moral and Legal Center. ECO and the Fair Housing Act together form the foundation of fair lending, making it illegal to discriminate in any aspect of a credit transaction. Quote, decisions must be based on merit, not prejudice. For your exam, the list of protected classes is an absolute must memorize. You will be tested on this. It's illegal to discriminate based on race, color, religion, national origin, sex, the basics. Also for credit, marital status, or age, provided the applicant has the capacity to contract. Can't deny someone just because they're single or older if they can legally sign. Also protected. Receipt of public assistance income or exercise of rights under the Consumer Credit Protection Act. Can't penalize someone for getting Social Security or for disputing a credit report error before. And under fair housing specifically, familial status, having children under 18, or handicap disability, protects families and those with disabilities. Commit this entire list to memory. Examiners will test your knowledge of every single one.
And related to discrimination, we hear terms like redlining. Can you clarify exactly what that is? And also reverse redlining.
Good question. These are vital for the exam. Redlining is the illegal practice of refusing to make loans or imposing stricter terms on properties in certain geographic areas, often based on the racial or ethnic makeup of the area. Think drawing a red line on a map and saying no loans here or only bad loans here because of who lives there. It's about exclusion. Reverse redlining is just as illegal, maybe more predatory. It's the illegal practice of targeting residents in those same areas for predatory loans with unfavorable terms. So instead of denying loans, you're aggressively pushing bad loans, high cost, unsustainable, knowing they have fewer options. It's exploitation. For the exam, redlining, denying worse terms based on area. Reverse redlining, targeting areas with bad loans. Know the difference.
Beyond those specifics, what about the broader idea of ethical conduct and this term UDAP? Unfair, deceptive, or abusive acts or practices sounds like the CFPB's way to catch bad behavior that doesn't fit elsewhere.
It really is. Mortgage pros are held to high standards. One concept, though not federal everywhere, is fiduciary duty. The highest standard of care, legally requiring an MLO to act in the borrower's best interest. Some states like Washington, California, Minnesota mandate this. Even if not federally required everywhere, understand the concept, putting the borrower first.
And UDAP, that seems like a powerful tool.
It is. Granted by Dodd-Frank, it lets the CFPB act against practices not necessarily violations of a specific law, but are deemed unfair, deceptive, or abusive. For the exam, know the distinct definitions. They test these separately. An act is unfair if it causes substantial injury that a consumer cannot reasonably avoid and is not outweighed by benefits. Basically, it hurts the consumer, they couldn't stop it, and there's no good reason for it. An act is deceptive if it is likely to mislead a reasonable consumer and the representation is material. It confuses an average person, and the misleading info matters to their decision. Think bait-and-switch ads. An act is abusive if it materially interferes with a consumer's ability to understand a product or takes unreasonable advantage of their lack of understanding, inability to protect their interests, or reasonable reliance on the MLO. This is about preying on vulnerability or confusion. Understand unfair, deceptive, abusive. Know the definitions, key for a perfect score.
Okay, let's map out the players in the mortgage world. Originators, appraisers. What are their specific jobs? And crucially, what can they not do? Especially processors and underwriters. Common, tricky questions there, I bet.
Knowing the roles and boundaries is vital. First, loan originators brokers. That's you. You must act as a reliable guide for consumers, ensuring they understand the loan process and products. They must be properly licensed and adhere to all state and federal laws. You're the guide. Now, pay close attention to loan processors. They perform administrative and clerical tasks under the supervision of a licensed MLO. Key phrase, under supervision. But here's the big prohibition, the exam favorite. They are prohibited from offering or negotiating loan terms or counseling consumers. They handle paperwork. They don't advise on rates or products. Cannot counsel.
Huge distinction. So they gather docs, but can't say, this loan looks good for you.
Exactly. No counseling on terms. Next, underwriters. They serve as a critical check and balance, verifying that a loan application meets all lender and investor guidelines, and that the information provided is accurate. They're the gatekeepers, making sure everything checks out. And finally, appraisers. They must provide an impartial, objective, and independent opinion of a property's value, complying with U.S. Mayor.
Right.
Impartiality is everything, which leads right into the independence rule.
Right. That independence is key for the valuation. How does the valuation independence rule under TILA protect that? What are the do's and don'ts?
The rule aims to prevent conflicts of interest and ensure reliable valuations. For your exam, know what's prohibited and what's permissible. Prohibited includes coercion, attempting to influence an appraiser's judgment by, for example, implying future business depends on reaching a certain value. Can't pressure them to hit a number, also prohibited. Conflicts of interest. An appraiser may not have a direct or indirect financial or other interest in the property or transaction. Common sense. Can't appraise your own deal. But just as important, know the permissible actions. You can. Ask an appraiser to consider additional appropriate information or comparables. If you think they missed a relevant comp, you can point it out. Request further explanation or correction of errors in the valuation report. If there's a clear factual mistake, like wrong square footage, you can ask for a correction. Obtain multiple valuations to ensure reliability. Getting a second opinion is sometimes necessary and allowed.
So no manipulating, but you can ensure accuracy. What if you suspect an appraiser did violate the rules? Is there a reporting requirement?
Yes, and this is critical. There's a mandatory reporting rule. Any covered person, including an MLO, who reasonably believes an appraiser has materially failed to comply with U.S. PAMP or other ethical requirements must report the appraiser to the appropriate state authorities. You have to report suspected misconduct. It's a legal and ethical duty. Common test question. Know what you can't do with appraisers and absolutely remember that mandatory reporting.
Okay, knowing fraud types is one thing, but spotting it. When you're looking at the actual paperwork, how do you become that mortgage detective?
Exactly. Recognizing anomalies is key. Let's look at some specific fraud schemes you need to identify for the exam. Liar loans. Borrowers inflating income on low documentation loan applications. Simple lying about money. Occupancy fraud. Falsely stating an intent to occupy a property as a primary residence, usually to get a better rate than an investment property would get. Straw buyers. Individuals paid to use their identity on a loan application for a property they do not intend to own. Someone else pulls the strings using their good credit. Heir loans. A loan obtained for a fictitious borrower using a fictitious property as collateral. Totally fake loan, fake property, fake borrower. Pure invention. Know each scheme by its description.
And beyond the schemes, what about red flags on the documents themselves? Those little details that scream problem. Examiners love testing the details.
These key red flags on documents are absolutely prime test material. Train your eye. General. Look for evidence of alterations, whiteout, inconsistent fonts, or round dollar amounts. Real finances are rarely neat, round numbers. $5,000 income exactly? Suspicious. Application. Watch for down payment from a non-cash source. Could be hidden debt. Or a buyer purchasing a smaller home while retaining a larger one as a rental. Might misrepresent occupancy or debt.
Yeah.
Income docs. Be wary if the employer's address is a P.O. box, date of hire is a weekend holiday, or pay stubs lack professional characteristics, IG watermarks. Could be fake docs. Appraisal. Red flags if comparables are from more than 6 months ago or are not physically similar, or if total net adjustments exceed 15% of the value, suggests maybe stretching to hit a value. These specific examples are crucial. Internalize them.
Beyond spotting it yourself, what about enforcement? What tools exist and what should companies do internally?
Well, the Fraud Enforcement and Recovery Act, FER, from 2009 really enhanced the federal government's ability to investigate and prosecute mortgage fraud, give them more teeth. Internally, companies need a strong compliance management system, CMS. It's a formal system, including policies, training, monitoring, and corrective action. A proactive approach, and handling complaints. The CFPB has a process. Companies must respond promptly, typically within 15 calendar days. Remember that 15-day window for the exam.
All right, let's pivot now to the absolute core of the exam.
Yeah.
The Uniform State Test material, the SAFE Act itself, its purpose, the regulators.
This is foundational. The Secure and Fair Enforcement for Mortgage Licensing Act of 2008, SAFE Act, landmark law. For your exam, you must know its primary goals verbatim. 1. Increase uniformity in licensing, less patchwork across states. 2. Reduce regulatory burden. Simplify things, ideally. 3. Enhance consumer protection, critical goal. 4. Reduce fraud through licensing and tracking. These 4 points explain why the SAFE Act exists, frequently tested.
So who enforces this, federal, state, or both? And how's that power split?
It's both. And knowing the split is key. Federal level. The CFPB holds the ultimate authority. They're the top dog. Took over from HUD. Remember, CFPB, state level. State level regulatory agencies are delegated authority. They handle the day-to-day implementation. But here's a key limitation, often tested. State regulators cannot create rules or requirements that exceed the authority granted to them by state law. They operate within the bounds set by their state's SAFE Act legislation.
And that classic confusion point, Regulation G versus Regulation H. Can you nail that down for us?
Definitely need this clear. Regulation G applies to mortgage loan originators who are employees of depository institutions, e.g., banks, credit unions. Think traditional banks. Regulation H applies to mortgage loan originators who are employees of non-depository institutions. For example, mortgage companies, brokers. Think standalone mortgage shops. Maybe G for government-backed general banks. H for home mortgage companies. Whatever works, lock it down. It's a common mix-up.
What powers do these state agencies actually have? They seem pretty strong.
They are. First, all states must participate in the NMLS, the national system, central database. They conduct thorough background checks reviewing criminal history via fingerprints, civil or administrative records, and credit history. No, those three parts of the background check.
And if they find violations, what can they do?
They have broad enforcement actions. Deny, suspend, revoke, condition, or decline to renew a license, can shut you down or limit you, issue cease and desist orders, stop illegal activity now, impose civil money penalties, fines, and order consumer refunds, make things right for harmed consumers. They also have strong examination authority, can investigate and examine any licensed MLO. During an exam, they can access and control all books and records, subpoena witnesses, administer oaths, very broad powers.
Diving into NMLS data, what's private versus public? This feels like a potential trick question area.
It is. Most info is confidential. But for the exam, know the exceptions for public access. What is public? 1. An MLO's employment history, where you worked. 2. Publicly adjudicated disciplinary and enforcement actions against an MLO. Formal public punishments. Memorize what is public. They often ask what isn't. Knowing these two precisely is key.
Let's nail down the absolute core definitions, starting with mortgage loan originator. What exactly is an MLO?
This is probably the most critical definition. An MLO is an individual who, for compensation or gain, 1. Takes a residential mortgage loan application, ND2, offers or negotiates terms of a residential mortgage loan. That ND is everything. You have to do both things for pay to be considered an MLO needing a license. Taking apps alone, not enough. Offering terms alone, not enough. Both together. Yes, MLO. Watch that MD.
So if they don't do both, like someone just handling paperwork, a processor.
Right. A loan processor or underwriter is individual who performs clerical or support duties under the direction of a licensed MLO. And remember the prohibition. A processor or underwriter may not represent to the public that they can perform the activities of an MLO. Reinforces their support role. Then the two types of MLOs based on employer. A registered MLO. An MLO who is an employee of a depository institution. They must be registered with the NMLS, bank credit union employees, versus a state-licensed MLO. An MLO who is not an employee of a depository institution. They must be licensed by a state and registered with the NMLS. Mortgage company broker employees. Registered versus state-licensed is fundamental. Know it cold.
And the unique identifier number. What is it and where does it have to show up? Seems simple but important.
It's the number permanently assigned by the NMLS to each MLO, your ID. For the exam, know where it must be displayed. On all loan application forms, the example, the 1003, and on all advertisements, solicitations, business cards, and websites. Ensures consumers can verify you. Memorize that list of places. Key consumer protection detail.
Knowing who needs a license is as vital as the definitions. Let's talk about engaging in the business and those important exceptions.
You're considered engaging in the business and require a license if you, in a commercial context and habitually or repeatedly, perform MLO activities, not just a one-time favor. Now, here's a key distinction, often tested. While processors underwriters employed by a company usually don't need a license if supervised, an independent contractor who performs loan processing or underwriting duties must be a state-licensed MLO. Big exception, because they aren't a direct employee under supervision. Watch for that.
And the people totally exempt from licensing. This list feels like prime exam fodder. Who doesn't need one?
It absolutely is. Memorize this list of exemptions from licensing verbatim. You'll see questions on this guaranteed. The following are not required to obtain a state MLO license. A registered MLO employed by a depository institution. They register, not state license. An individual who performs only real estate brokerage activities, just selling houses, not originating loans. An individual who negotiates a mortgage on behalf of an immediate family member, spouse, child, sibling, parent, grandparent, grandchild, or step-adoptive relations. Personal transaction for close family. An individual who negotiates a mortgage secured by a dwelling that served as their own residence, selling your own home. An employee of a bona fide nonprofit organization, provided the organization meets specific criteria, for example 501c status, promotes affordable housing, allows legit nonprofits to help without full licensing hurdles. This list is tested frequently. Know it cold.
Okay, so if you do need a license, what's the application process like? What are the steps?
The license application process starts with basics. Applicants must furnish fingerprints for a criminal background check and authorize a credit report check, mandatory upfront checks, then pre-licensing education, PE. Total of 20 hours of NMLS-approved education is required. For your exam, The breakdown is critical. 3 hours on federal law and regulations, 3 hours on ethics, including fraud, consumer protection, and fair lending, 2 hours on lending standards for the non-traditional mortgage product marketplace, riskier loans, and 12 hours of undefined instruction. Electives know that exact 33212 breakdown for PE, absolutely tested.
And the safe MO test itself, passing score, and more importantly, the retesting rules. Those seem crucial for planning.
Passing score is 75% or higher. Clear target. And yes, the retesting rules are critical and tested. An applicant must wait at least 30 days between the first and second attempts, and between the second and third attempts, 30-day wait between tries 1, 2, and 3. But here's the big one. After failing 3 consecutive times, an applicant must wait at least 6 months, 180 days, before taking the test again. That 180-day rule is a very common exam question. Commit it to memory. Avoid that 6-month wait.
Any financial responsibility issues that could block a license even after passing the test?
Yes, your financial history matters. You may be denied a license if they show disregard for managing their finances, shown by current outstanding judgments, except for medical expenses. Non-medical judgments are a problem. Current tax liens, failure to pay taxes, and foreclosures or a pattern of seriously delinquent accounts within the past 3 years shows financial instability.
And the absolute deal breakers, the non-negotiable reasons for license denial.
These are the grounds for license denial. Know these verbatim critical disqualifiers. A license must be denied if the applicant has ever had an MLO license revoked unless the revocation was vacated. A previous revocation is usually a permanent bar, has been convicted of any felony within the last 7 years. 7-year look back for any felony, but, and this is key, has been convicted of a felony at any time involving fraud, dishonesty, a breach of trust, or money laundering, unless the conviction was pardoned. For these specific financial felonies, it's a lifetime ban unless pardoned. No 7-year limit. That distinction, any felony within 7 years versus specific felonies any time, is prime exam territory. Understand it precisely.
Getting the license is just step one. Keeping it active means ongoing work, right? And knowing the rules of what not to do.
Exactly. Maintenance is key. Annually, you need continuing education, CE. Total of 8 hours of NMLS-approved education is required annually. Just like PE, know the breakdown for the exam. 3 hours on federal law, 2 hours on ethics, 2 hours on non-traditional mortgage standards, and 1 hour of an elective. Compare this 3-2-2-1 breakdown to the PE hours, 3-3-2-12. They love to mix these up on tests. Also, licensees submit mortgage call reports, MCR, to NMLS periodically.
What if you're licensed in one state or registered and want to work in a new state? Is there a temporary pass while you get the new license?
Yes, transitional authority, newer rule, often tested, enabled by EGRRCPA. It allows a registered MLO or an MLO licensed in another state to obtain temporary authority in a new state while completing the licensing requirements. Conditions. MLO must not have had a license denied or revoked and must have submitted a new application. Key detail for the exam. Duration is a maximum of 120 days. Remember that 120-day limit.
Now back to the bad stuff. Specific prohibited acts and practices. What concrete behaviors are off limits and lead to penalties?
The model state law prohibits a wide range of conduct, including, know these exam favorites, engaging in any scheme to defraud or mislead borrowers or lenders. Broad but foundational. Engaging in unfair or deceptive practices. Back to UDAP. Bait and switch advertising. Luring with one deal, switching to another, making false statements on reports to the NMLS. Lying to the regulators serious, attempting to influence an appraiser's judgment of value, violates independence rules. Failing to truthfully account for funds belonging to a party in a transaction, mishandling money. These are critical behaviors to avoid. Expect scenario questions.
And the maximum penalty. What's the biggest fine per violation?
State agencies can impose civil penalties. For the exam, know the number. The maximum penalty under the model state law is $25,000 for each act or omission. That $25,000 maximum is a specific figure to remember, and it's per violation, so it adds up fast.
Beyond safe act specifics, the exam hits key federal laws and general mortgage knowledge too, often tied back to the ethics we started with.
That's right. Let's cover the big ones quickly, focusing on exam essentials. First, revisit, or RESPI, Regulation X, purpose. To help consumers become better shoppers for settlement services, then to eliminate kickbacks and referral fees. Section 8 prohibits that thing of value in exchange for the referral, and fee splitting where services are not actually performed. Honest, earned fees.
And RISPI's critical disclosure timelines, again, those are definite exam questions.
Absolutely. Required disclosures and timelines are must-knows. Loan estimate, LE. Delivered or mailed no later than the 3rd business day after receiving a consumer's application. 3rd business day. Closing disclosure, RAISE-D. provided at least 3 business days prior to consummation. 3 business days before the consumer is obligated. Also remember initial and annual escrow statements, and the servicing transfer statement needs 15-day notice period. Memorize LECD timelines in the servicing transfer notice period.
Okay, back to TILA, Regulation Z, core purpose,
Yep.
and that right of rescission again.
TILA's purpose: to promote the informed use of consumer credit by requiring disclosures about its terms and cost, particularly the APR. Transparency, right of rescission, super important, often confused. Applicability: applies to refinances on a primary residence, home equity loans, and ELOX. Critical distinction for your perfect score: it does not apply to purchase transactions. Cannot rescind a purchase loan. Timeline: allows the consumer to cancel the transaction within 3 business days. Cooling off period: but if notice is bad, the rate extends to 3 years. Know when it applies, not purchases, and the 3-day, 3-year timelines. Also under TILA, ability to repay, ATR, and qualified mortgage, QM, requires a reasonable good faith determination of ability to repay. A QM is a loan presumed to comply with the ATR standard, offers a safe harbor.
And ECOA Regulation B, the anti-discrimination law. Key details.
Notification timing. ECOA's purpose: to ensure that all consumers are given an equal chance to obtain credit. Prohibits discrimination based on those protected classes we listed: race, color, religion, national origin, sex, marital status, age, public assistance, exercising rights, familial status, handicap. Key detail for exam: notification requirement. Creditor must notify an applicant of action taken within 30 days of receiving a completed application. If denied, adverse action notice needed. Remember that 30-day ECOA notification.
Any other quick federal regulation hits? Just associating the acronym with the function?
Yep. Quick association drill for the exam: extra facta, credit report accuracy privacy, red flags rule, identity theft. GLBA protects NPI, privacy rule, safeguards rule. HMDA, data reporting, spot discrimination patterns. MAP, regulation N, prohibits mortgage advertising misrepresentations. USA Patriot Act. Customer ID program, CIP for anti-money laundering, AML. Know the main job of each acronym.
Finally, let's wrap with essential general mortgage knowledge: loan programs, application basics.
All right, practical stuff. Loan programs, conventional, not just gov-backed. Needs PMI for LTVs over 80%. FHA, government insured. Requires MIP, upfront and annual. VA, government guaranteed. No mortgage insurance, but has a funding fee. USDA, gov guaranteed for rural areas. Distinguish PMI versus MIP versus funding fee and their loans. Common mix-up. Application and qualification process. An application under Tree I needs 6 items. Memorize these verbatim: name, income, SSN, property address, estimated value, loan amount. Get these 6, you have an application triggering disclosures. Underwriting uses the 3 Cs. Memorize verbatim. Capacity, DTI ratio. Can they afford it? Credit, FICO score. Do they pay bills? Collateral, appraisal, and LTV ratio. Is the property good security? Know the 6 items of an application and the 3 Cs. An appraisal process provides independent opinion of value. Sales comparison approach is most common for residential, comparing to similar recent sales.
Wow. Okay, we have really covered a massive amount of ground today, seriously. You've just gone through the ethical foundations, the specific fraud types, our RESPA, TLA, GLB compliance rules, every key bit of the SAFE Act, definitions, retesting rules, the works, plus essential federal laws and general mortgage knowledge. You basically have a complete detailed map now of what's on that exam. And here's where it gets really good for you, our listener. With this level of detail, knowing those verbatim definitions, those subtle distinctions, you're not just set up to pass, you are genuinely prepared to nail it, to get that perfect 100 on 100.
Yeah, and this whole deep dive, it kind of brings up a bigger question for you, the listener, doesn't it? We focused hard on the facts, the precision for the test score, which is vital. But think about how these laws, these ethical principles, how they'll actually play out day to day in ways you might not expect. How will really understanding these rules, not just memorizing them, help you protect your clients, protect yourself when tricky situations pop up that aren't exactly in the textbook. The exam is a checkpoint, a big one. But mortgage lending keeps changing. Being able to connect these foundational dots, understanding the why behind the what, that's going to be your biggest asset long after you've passed.
Absolutely. Go out there, crush that SAFE exam, and be the best loan officer you can possibly be. Informed, ethical, ready for anything. We've just given you the ultimate deep dive to get you there.